What's up guys, David here, DeFi Strategies. Cryptocurrencies like Bitcoin and Ethereum represent a new era of technology. With transformative user experiences and endless possibilities through the implementation of code, people around the world are being connected financially in ways never before possible. Today we'll go in depth on some crypto use cases and what the buzz is all about. We'll discover some of the advantages of using cryptocurrencies over other currencies like the dollar and determine if it's just a fad for tech enthusiasts. The answer may surprise you. I know it surprised me. Without further delay, let's get started. The rapid growth of the crypto ecosystem presents new opportunities. Technological innovations are ushering in a new era that makes payments and other financial services cheaper, faster, and more accessible to everyone. Crypto asset technologies have potential as a tool for faster and cheaper local or cross-border payments. Bank deposits can be transformed to stablecoins that allow instant access to a vast array of financial products from digital platforms and allow instant currency conversion. Decentralized finance could become a platform for more innovative, inclusive, and transparent financial services. Decentralized finance, or DeFi, is a blockchain-based form of finance that does not rely on centralized financial intermediaries such as brokerages, exchanges, or banks to offer financial services. DeFi is possible through the automation of traditional financial functions, often referred to as smart contracts. Smart contracts are programs that exist on blockchains. DeFi platforms allow anyone to lend or borrow funds from others, trade a range of assets and cryptocurrencies, as well as insurance against risks and high interest in savings accounts. DeFi uses a layered architecture of highly composable building blocks, making it easier for entities to share work and rapidly advance this growing ecosystem. There are about 100 billion in assets being utilized in the DeFi ecosystem today. Smart contracts are accessible through dApps, decentralized applications similar to the apps that you'd use on your cell phone. dApps can interoperate to create complex financial services. For example, stablecoin holders can lend assets to a liquidity pool in a borrow lending protocol like Aave and allow others to borrow these digital assets by depositing their own collateral, typically more than the amount of the loan. The smart contract automatically adjusts interest rates based on the moment-to-moment demand for a particular asset. Some dApps even source external or off-chain data, such as the price of an asset, through blockchain oracles like Chainlink. Additionally, Aave introduced a new financial concept called flash loans, which are uncollateralized loans of an arbitrary amount that are taken out and paid back within a single blockchain transaction. Uses for flash loans include arbitrage, collateral swaps, self-liquidation, and unwinding leveraged positions. Another DeFi protocol called Uniswap is a decentralized exchange, or DEX, that runs on the Ethereum blockchain. Uniswap allows for the trading of hundreds of different tokens issued on the Ethereum blockchain. Rather than using a centralized exchange to fill orders, Uniswap incentivizes users to form liquidity pools in exchange for a percentage of trading fees that are earned from traders swapping tokens in and out of the liquidity pool. These liquidity pools allow users to switch from one token to another in a fully decentralized manner, while maintaining control over their funds. At the same time, liquidity providers are encouraged to deposit tokens for a portion of the fees generated by the exchanges. After having pooled their tokens, liquidity providers may remain completely passive as the smart contract takes care of automatically adjusting the liquidity providing logic depending on the current market prices. DEXs are powered by automated market makers, or AMMs, which are based on mathematical formulas, making it possible to calculate the exchange rate between two assets by considering the liquidity present in the protocol. As institutional adoption of Bitcoin and Ethereum continues to progress, there are endless possibilities to take advantage of newer, more innovative blockchains. You just need to know where to look and how to evaluate the technical architecture of each chain. We're here to help you with that. Like the dollar represents the US economy and the euro represents the European economy, cryptocurrencies are the currencies for a digital, open, and global economy. The crypto ecosystem continues its rapid growth, presenting tremendous opportunities for developed and emerging markets alike. Crypto assets come in different flavors and have evolved to meet the varying needs, including long-term investment, preserving value in inflationary environments, currency conversion, and payments. Cryptoization is the transition from traditional financial assets to digital assets. In emerging markets, the advent of crypto assets has incredible benefits and helps accelerate cryptoization and circumvent inhumane exchange and capital control restrictions. Increased trading of crypto assets in these markets could lead to expansionary capital flows and flourishing economies. For emerging markets and developing economies, greater use of crypto assets presents some significant benefits and macro financial protections, especially with respect to asset and currency substitutions in countries that don't have a national currency, outsourcing their monetary policy to the United States. There are several driving forces for cryptoization. Unsound macroeconomic policies combined with inefficient payment systems in some emerging markets and developing countries boosts crypto adoption. Some potential pull factors for crypto adoption, such as speculative retail investing, may be common across countries, but some of the recent drivers are likely more specific to a subset of emerging markets and developing economies. The rapid deterioration of central bank credibility combined with multi-decade inflation highs indicates serious vulnerabilities in the banking sector and the broader traditional financial markets. The continued devaluation of fiat currency could trigger asset substitution as residents flee a crashing currency to seek a safer alternative. The crypto ecosystem can help domestic residents convert and protect their life savings from becoming worthless. For example, global crypto exchanges or other more secure methods such as P2P transfers can be used to bypass inhumane capital flow management measures. Even people living under oppressive governments can bypass the corruption through the use of digital assets. Through the use of crypto wallets, those trapped in a currency crisis can store their savings offshore. Inefficiencies in payment systems and limited access to financial services can also be a driver of dollarization. One prominent example of inefficiencies is the lack of interoperability among various domestic payment systems, which can be a problem for remittance as well as trade. Given the large share of unbanked people in some emerging markets and developing economies, remittances often take place through cumbersome cash-based methods, such as those of post offices and other transfer operators. The payment rails of crypto assets can make some of these services faster and cheaper, especially through the integration of stablecoins, which allow for a stable unit of account. Stablecoins can be dramatically more accessible since they only require a mobile phone or internet connection. Often bank locations can be scarce in many countries as it is not economically viable to have branches within reach of the entire population. The market capitalization of crypto assets has grown significantly. Through early May, the market capitalization almost tripled in 2021 to an all-time high of $2.5 trillion. This was followed by a 40% fall in May as unfounded concerns about the environmental impact of crypto assets grew and global regulatory scrutiny of the crypto ecosystem escalated. The sharp declines during May were likely exacerbated by high use of leverage, which led to automated liquidations of margin and futures positions by exchanges. Since then, the market value of crypto assets has increased again to more than $2.5 trillion, with periods above $3 trillion. The attractiveness of these crypto assets can be seen when compared to national currencies that experience large drawdowns, such as Venezuela, Turkey, Argentina, and Haiti, to name a few. However, this applies to any country with weak currency fundamentals, including the United States. Another argument often put forward in favor of non-stablecoin crypto assets is their low correlation with other assets, offering diversification benefits to investor portfolios. A key component of the rise in market capitalization is increased interest in stablecoins, newer technologies such as smart contract blockchains, decentralized finance, and decentralized governance. The stablecoin market cap has quadrupled in 2021 to more than $120 billion. Stablecoin trading volumes outpace those of all other crypto assets primarily because they are usable for settlement of spot and derivative trades on exchanges. The price stability for top stablecoins continues to improve, as can be seen in the declining price deviations for the targeted pegs against the dollar and other currencies in 2021. Their relative price stability has shielded users from the volatility of other crypto assets, which means they do not have to move their funds outside of the crypto ecosystem. Stablecoins fall into a few main categories: crypto asset-based and non-crypto asset-based. Crypto-backed stablecoins can further be divided into centralized and decentralized. Non-crypto stablecoins claim to be fully backed by non-cash equivalent assets, for example, corporate bonds, commercial paper, or commodities and cash. Issuers and exchanges may market these stablecoins as immediately redeemable at face value, but in some cases, especially during deviations from the peg, some issuers may defer redemption, offer in-kind redemption, or impose higher redemption fees. Examples of non-crypto-based stablecoins include Tether and USD Coin. Crypto-based stablecoins, for example, DAI, is often over-collateralized by a portfolio of crypto assets such as Ethereum, wrapped Bitcoin, and USDC coin. These stablecoins are usually structured on a decentralized non-custodial basis and are considered part of DeFi. A further category comprises algorithmic stablecoins, also referred to as non-collateralized, that aim to maintain their peg using algorithms that increase or decrease the supply of tokens according to market conditions. Currently, no stablecoin arrangement fully meets the centralized status. An example of such a stablecoin would be one issued by a commercial bank, subject to the same requirements that have marginalized billions of people around the world. A centralized stablecoin would be similar in form and function to fiat money. Keep in mind that decentralized stablecoins are democratized through governance structures, providing community oversight to any protocol changes proposed by network developers. With decentralized stablecoins, there are no burdensome requirements that would exclude anyone from participating. Since it can be very difficult, if not impossible, for governments to control, these stablecoins provide a safety net for those outside of the traditional financial system. Some elements of stablecoin arrangements are regulated for conduct and prudential purposes. Some stablecoin issuers, such as trust companies and money transmitters, have been licensed and regulated by the existing regulatory framework in the United States. Furthermore, some exchanges and wallet providers that support stablecoins may fall under anti-money laundering requirements, while some reserve managers and custodians may be regulated entities. Some stablecoins can be subject to runs driven by doubts regarding redeemability at peg due to questionable reserves. A run, commonly known as a bank run, typically occurs when a bank's clients withdraw their money because they believe it may run out of money in the near future. The same principles apply to some stablecoins. For example, Tether was recently audited and fined for lying about their reserves during an investigation led by the New York Attorney General. Taking a deeper look into Tether reveals that it is backed by almost no cash, but rather illiquid, short-term, unsecured, uninsured loans from corporations. As national debts in the US and China increase, a widespread and significant correction in the global economy could be on the horizon. This is especially daunting considering the Fed has announced it will begin raising rates and quantitative tightening. A Tether run could also trigger a fire sale of commercial paper. In many jurisdictions, including the United States, the liquidity of commercial paper is worse than that of other short-term assets, such as government bills. Especially during periods of market stress, as seen during the market sell-off in Q1 of 2020. The contagion risk of Tether is much higher since reserve assets are highly concentrated in particular issuers and sectors and have extremely poor disclosures. By not having adequate disclosures, participants in Tether cannot accurately evaluate its risk profile. The information to do so is simply not available. Although this risk might be Tether-specific for now, given its size and type of holdings, this kind of contagion risk could evolve for other stablecoins in the future. Although Bitcoin remains the dominant crypto asset, its market share has declined sharply in 2021 from more than 70% to less than 45%. Market interest has grown for newer blockchains that use smart contracts and aim to solve the challenges of earlier blockchains by introducing features to ensure scalability, interoperability, and sustainability. The most prominent are Ethereum and CARDANO. Bitcoin is the first cryptocurrency. Its white paper was published in 2008 and can be read on bitcoin.org, with its Genesis block created on January 3, 2009. Bitcoin was created as a response to the financial crisis and for the first time gave anyone the option to simply exit the financial system. No longer are the people of a nation able to be held captive by the exploitative monetary policy and rampant inflation. We as people no longer had to go down with the banks because there was a new disruptive alternative. Bitcoin functions like digital cash. It can be exchanged from me to you or peer-to-peer with no opportunity for censorship or a third-party involvement. Ethereum was founded in 2013 by Vitalik Buterin, Charles Hoskins, Gavin Wood, and many others. It was built as a second-generation cryptocurrency designed to support various networks and financial products. Ethereum allowed for more complex programs to be written on it, called smart contracts or dApps. The Ethereum community has built a booming digital economy with thousands of dApps, providing new ways for creators to earn online. It's open to everyone, wherever you are in the world. In 2017, Hoskinson left the Ethereum project to found the CARDANO blockchain, the world's first third-generation cryptocurrency. It was inspired by Ethereum with the goal of greater scalability, lower fees, and more sustainability. Unlike Ethereum, Cardano has already transitioned to proof of stake. a less energy-intensive form of network security. CARDANO also aims to bring metadata on-chain. This would allow billions of unbanked or underbanked individuals around the world without appropriate documentation to form a credible identity to access traditional finance for the first time. If you remember Alice from a previous video, she was struggling to get her business started because she lacked credentials and was faced with high remittance fees from abroad. With CARDANO, Alice can form an identity using legal metadata on-chain to gain access to simple financial services like a checking or savings account. She can also receive funds from abroad for an affordable fixed cost. The size of DeFi markets grew from 15 billion at the end of 2020 to 110 billion in September 2021, largely due to the growth of decentralized exchanges and DeFi applications without the need for any credit checks. These services operate directly on blockchains without customer identification requirements. Most of DeFi is built on the Ethereum blockchain and uses Ethereum-based tokens, including stablecoins. DeFi is also one of the main drivers of the rapid growth of stablecoins and warrants closer attention. Chainalysis, however, highlights that DeFi users for now are primarily institutional players from advanced economies, whereas adoption among retail users in emerging market and developing economies in general is lagging. The pressures of globalization, functional differentiation, technological specialization, and governance mechanisms have become increasingly decentered, horizontal, and ultimately networked. Policymaking no longer relies primarily on the exerted power of a single actor, whether an individual, corporation, or the state. Instead, blockchains are becoming increasingly governed by networks that comprise a diverse set of participants who ultimately vote on changes to the code. This leads many to wonder to what extent new technologies like blockchain technology can contribute to effective and legitimate governance mechanisms. For example, for those unfamiliar, the MakerDAO protocol has been a shining example of what successful on-chain governance looks like. The MakerDAO governs the largest decentralized stablecoin, DAI, D-A-I, an unbiased collateral-backed cryptocurrency, soft-pegged to the US dollar. Resistant to hyperinflation, DAI offers economic freedom and opportunity to anyone, anywhere. The Maker protocol allows users to generate DAI by leveraging collateral assets approved by the Maker governance. Maker governance is the community organized and operated by the Maker token holders. MakerDAO has effectively executed polls that measure both sentiment and continued approval by Maker voters. The process of managing the various aspects of the Maker protocol successfully parameterized the protocol to allow the community to dictate its ultimate course. Innovations that have given rise to the crypto ecosystem are significant and can create tangible benefits for developed and emerging economies. Since 2017, crypto has grown to the point where it can no longer be ignored. Market capitalization has grown by a factor of 10 and is now comparable to some established asset classes such as U.S. high-yield bonds. It is still small, however, compared with government bond and stock markets in major advanced economies. Episodes of loss in confidence in the dollar, euro, and other national currencies have had substantial spillovers to the broader crypto markets, due in part to endless government spending and money printing by central banks worldwide. Confidence effects from failures of fiat-denominated asset providers have so far been limited. The importance of crypto is rising as trading volume in some countries' exchanges have increased dramatically and in some cases are comparable to the volumes of their respective stock exchanges. New sources of opportunity are emerging, such as stablecoins and DeFi, which did not exist on a large scale in 2017, when I first got involved in this ecosystem. In the future, a widely used stablecoin or DeFi service with a reach and use across multiple jurisdictions could scale up quickly and become a viable alternative to traditional transmission rails. The use of crypto assets for payments and settlements, although limited, has accelerated rapidly, given that several global payment companies are now integrating with the crypto ecosystem, particularly with stablecoins. Crypto adoption in some emerging market and developing economies has outpaced that of advanced economies. According to a recent survey, the top 5 countries using or owning crypto assets in 2020 were emerging market and developing countries, whereas the lowest adopters were generally advanced economies, including the United States. Some emerging market country-specific surveys also show a large jump in adoption over the past year. Beyond surveys, tracking country-specific adoption can be challenging. So far, there's no reliable way to estimate the stock or flow of crypto assets based on country residency. A commonly used proxy is residency estimates based on internet visits to websites of crypto asset providers. These confirm the survey data to show that the popularity of several global crypto exchanges among emerging market and developing economies, but they also cannot measure the actual use of crypto assets. Another metric is the size of trading volumes of crypto exchanges that operate only in specific countries rather than globally. Among a sample of such exchanges in emerging markets and developing economies, the reported trading volume in 2021 rose sharply, and in some cases, volumes have become comparable to the activity on the local stock exchanges. Some blockchain analytics companies attempt to infer the residency of on-chain crypto asset flows. Similar to surveys, data shows that adoption in emerging markets and developing economies is rising and has outpaced those in advanced economies. Due to data gaps, the interpretation of the data poses significant challenges. The macro-financial effects of crypto are directly proportional to their degree of adoption. The more widely accepted crypto becomes, the more its benefits can shine for those who need it the most, rather than for investment purposes. For now, we have seen limited adoption of crypto for remittances, with marginal impacts to local economies or monetary policy. When crypto is used for payments, the asset will likely be held for a short time before it's exchanged back into a local currency for domestic purchases. More extensive degrees of adoption, such as the adoption of stablecoins as means of payment and store of value, can pose more significant benefits by eliminating the need to convert back to an unstable local currency, reinforcing open financial forces in the economy. Stablecoins can be a life raft to populations trapped under failed implementations of effective central banks' monetary policy and lead to financial stability within the household. Cryptoization can decrease seigniorage revenue and shrink the role of central banks and governments in an economy, restoring control to the individual. Seigniorage revenue is the profit obtained from debasing a currency. This occurs when the face value of the currency does not match its intrinsic value. For example, a government can produce a $100 bill for $1. For each bill produced, the government nets $99 in revenue. Where does this revenue come from, though? It is stolen from the participants in that currency, exploiting the power imbalance it has over the people that accept that money. Simply put, purchasing power cannot be created out of nothing. This process produces inflation because once it leaves the hand of the government at fake face value, it trades in the market at its actual intrinsic value. Crypto solves this by freeing people from the currency debasement. In 2020, while unemployment soared and having savings was critical, the U.S. central bank, called the Fed, decided that that was the time to substantially debase the currency when U.S. residents needed their savings the most. The M2 money supply in the United States increased by 25%. Did your wealth or income increase by 25% in 2020? Most would say no. To further rub salt in the wounds of Americans and dollarized economies, the Fed printed 5.8 billion new banknotes, 600 million more than expected. For fiscal year 2021, the Fed has plans to increase that number to 9.6 billion, an increase of 66% over fiscal year 2020. The adoption of a crypto asset as the main national currency carries significant benefits. El Salvador, a dollarized economy, recently adopted Bitcoin as a national currency alongside the dollar. This was a move by President Nayib Bukele aimed at increasing financial inclusion for the 70% of Salvadorians without bank accounts, while also reducing remittance fees from capital coming into the country. Already, more Salvadorians have Bitcoin wallets than traditional bank accounts. The various forms of crypto mining rewards network participants for providing network security. For example, the value of mining revenues in 2021 has exceeded $1 billion per month on average for each of the Bitcoin and Ethereum blockchains. Mining revenue can help marginalized populations circumvent inhumane capital flow restrictions, as well as international financial sanctions that prevent remittance to those that need it the most. Given that the main operating costs of miners are normally paid domestically in local currencies, but their revenues are paid on-chain in the form of crypto assets. For instance, one graphics card mining Ethereum can pay the cost of rent in places like India and Vietnam, providing incredible financial freedom for everyday people on the periphery of the financial system. In this new digital age, banks are beginning to realize that they now have to compete with crypto. Unlike previous technological innovations, it can't be bought out and destroyed or legislated out of existence. The banking system is used to not having to compete like most other market segments. Banks have never had to compete with another, better, cheaper, and faster alternative that exists entirely outside of their control. Stronger competition for bank deposits through stablecoins held on crypto exchanges or private wallets may diminish the power of local banks as customers leave seeking better, modern alternatives. Beyond the direct savings in banking fees, individuals can opt to forego credit risk assessments and use applications in DeFi that simply don't require it. This may seem impossible, but through complex algorithms and collateralization requirements, the need for a credit risk assessment is rendered obsolete. Fintech innovation, including the crypto ecosystem, has the potential to improve fundamental aspects of the macroeconomy with better financial services and greater financial inclusion, especially in emerging markets and developing economies. For the first time, whether policymakers prioritize financial innovation and their commitment to open, free, and contestable markets or not doesn't matter. Those that don't adopt will be left behind. Depending on country circumstances, various forms of crypto assets may be adopted, and their economic functions may vary. Different countries have different policy priorities arising from the degree of crypto adoption. For example, the inclusion of the unbanked, connected with the adoption for transaction purposes, provides a framework for bringing financial tools to everyone. Despite the need to provide basic financial services to the most marginalized populations globally, national regulators are doubling down on their efforts to destroy this grassroots movement. Regulators are making strong efforts to enhance cross-border coordination of supervision and enhancement actions. Outright bans on crypto have been discussed and executed in some jurisdictions. These efforts have a direct impact on crypto businesses, but have a very limited effect on personal use, since individuals can simply use other modes of exchange. Ironically, if regulators could read the room, they would find that these efforts will increase the rate of cryptoization as more people are excluded from the financial system. Regulators globally are attempting to make a coordinated effort to snuff the momentum of cryptoization, but will ultimately fail because there will always be geographies around the world where it is beneficial to go against the status quo. This is in part why tax havens exist. Alternatively, developing and emerging economies simply may not have the resources needed to enforce recommendations from developed countries. In the case of El Salvador, part of the reasoning for adopting Bitcoin is the possibility of capital inflows for investments in their economy. It is important to ask, in whose best interest is it to enact these mass surveillance measures? To close, I want to share the reality of the current macroeconomic situation on the African continent, but this applies to developing resource-rich countries as well. Despite my background in finance, economics, and math, the following question remains unanswered. Why is it that 2,000 units of their currency is worth 1 unit of mine, when they are the ones with the natural resource reserves needed to back a strong currency? Counter to popular belief, aid is coming from the undeveloped world to the Western world, not the other way around. The developed world depends on Africa in every possible way due to the 20+ types of abundant natural resources there. So how does the West ensure free aid keeps coming in? It is done by systematically destabilizing the wealthiest African nations, backed by a huge PR campaign, leaving the world to believe that Africa is poor, and merely surviving off the West's generosity. Well done, UNICEF, the Red Cross, and other organizations that run multi-million-dollar ad campaigns depicting charity pouring in to sustain that image globally. I can remember in elementary school being taught about the absolute destitution on the African continent. We were taught about the charitable works of entities like UNICEF and even encouraged to bring UNICEF boxes around with us as we went door to door trick-or-treating. All of this to maintain the illusion that we are the good guys. While one hand gives under flashing lights, the other takes in the shadows. We all know the dollar is worthless. The US, France, and others exchange their colored paper for cheap gold and diamonds. Instead, we should come to underdeveloped nations with integrity and invite them to participate and share in the broader global markets. This presents the West with a problem. A striving Africa would not disperse its resources so freely and cheaply. Logically, of course. Instead, it would sell them at world market prices, weakening Western economics established on the post-colonial system. The French Treasury, however, receives $500 billion a year, every year, for exchange reserves from African countries based on debt from their original colonization they are still forced to pay. Former French President Jacques Chirac stated in a 2008 interview that we have to be honest and acknowledge that a big part of the money in our banks comes precisely from the exploitation of the African continent, and without it, France would slide down to the rank of a third world country. Crypto acts as an equalizing force, providing a foundational set of rules that cannot be changed regardless of wealth or power. Blockchain technology has the potential to disrupt the status quo, restoring autonomy to the individuals who need it the most. The advantages are clear, just like the advantages of staking with us. Go to mainblockchain.com/stake for more information about delegating your Cardano to our pool for up to 5% APY compounding. Staking your Cardano with us is easy and secure. Your funds remain liquid and never leave your personal wallet. Thanks for watching, guys. For more content, check out Black Bear Crypto. Like and subscribe for more content, and connect with us on Linktree at DeFi Strategies.